My name is Liane Schalatek. I'm the Associate Director of the Heinrich Boell Foundation North America, one of the two co-organizing organizations. I want to start out with thanking the Center for Economic Policy Research, particularly Dan Beaton, for being a partner in crime and cooking up and organizing that event. But I also wanted, just so that we don't forget it, thank the Stuart R. Mott Charitable Trust for allowing us the use of this wonderful facility here on Capitol Hill. And I think we really have a timely event and debate today. And I know this is a very often used little adjective in events for Washington DC. It is for a timely, but I think in that case it is very much true. As you all know, both the House and the Senate voted just within the last 3 days on the War Supplemental Appropriations Bill Conference Report. That's a mouthful. I had to look it up twice this morning just to make sure that I get the words right, which actually grants a new credit line from the US side to the IMF for lending, for the IMF's response to crisis lending. And while the decision on Capitol Hill might have been made, you know that the decision was very contentious. I think the discussion is going to reach on not only whether it might have been a good decision, but it's a fait accompli, the decision is done, but also on the kind of lending we think is needed, or a lot of groups think is needed to deal with the crisis in developing countries, in low-income countries, in high-income countries, and also obviously in the industrialized world. I want to start off, and I think that's the prerogative of an organizer, with the plug for our own organization. First of all, I wanted to introduce to you the new director of the Washington office of the Heinrich Boell Foundation, my colleague Klaus Linsenmeier. And Klaus should stand up here. Not all of you have met him yet, but I'm pretty sure you will see a lot of him. He brings a lot of experience in development issues, and so I think he's a great asset for the office. And I would likewise like to introduce a new member joining the Heinrich Boell Foundation North America team, Nancy Alexander, who's going to moderate today's debate. As some of you might have heard, those of you who care, I'm going on a 14-month sabbatical, and Nancy has graciously agreed to fill in during the time that I'm gone, and I think it's definitely a plus for the foundation that we're going to have her. And with that, I would like to pass it on to Nancy.
Good morning, everyone, and welcome to the Mott Foundation, Mott House. I'm really pleased to moderate this event, my first week, filling some large shoes of Liane Schalatek, and to moderate this event. 2 years ago, an economist many of you know, Nobel Prize winner Joe Stiglitz, testified before the House Financial Services Committee chaired by Barney Frank, and he said, one thing it's important to remember is that the IMF and World Bank should not be designing policies that could never in a million years pass in the United States. And Barney thought that was an interesting benchmark about which to think about IMF policies, and their not only the substance of the policies in economic and social ways, and but also the procedure by which the policies are introduced in member countries. And you know, today we're going to hear some views on this question, and some very different views, and I think that we're really honored to have such distinguished and expert panelists to address perspectives on the IMF, and this is a very propitious time to hear from them, because we just saw the war supplemental passed with the IMF money attached, including some extra money for low-income countries if that goes through negotiations successfully. And we're about to see the passage of the Foreign Operations Bill, which likewise will have some IMF language included. So this is a very propitious time to think about these weighty questions. And we'll hear first from Rob Weismann, who's Director of Essential Action, an organization which has long campaigned for IMF reform. Rob is also editor of the bi-monthly Multinational Monitor, which reports on international economic issues. And Rob is going to give us kind of an overview of the dynamics that we've seen play out in Washington over this unexpected addition of IMF conditions on the war supplemental. And after Rob speaks, I'll introduce the other panelists, but I'll say at this point in time that we'll hear next from Mark Weisbrot, who will provide a critical perspective on IMF operations, and then from Hugh Bredenkamp of the IMF, who will provide insight from the perspective of the institution itself. And we're lucky to have a wrap-up speaker who describes himself as stridently nonpartisan. How often in Washington do you hear anyone describe himself that way? So we're excited to hear from these speakers, and we'll begin with Rob, and then I'll introduce the others in turn.
So this is a strange room. I'm kind of in the corner, tucked away in the margins where I feel most comfortable. Thank you very much, Nancy and Leanne and CEPR and the other panelists. Let me just say two things to start, and then I'll give you some remarks that I'm trying to make up as I go along, because Nancy just gave me my charge 5 minutes ago. One thing is, I hope that, along with Mark, I'll offer a critical perspective, so it's not just Mark who's the critic of the IMF. And two is, that's an interesting comment from Stiglitz. Another interesting comment might be, no country should be forced to adopt a set of IMF policies that it itself would not adopt. But for the fact that it was imposed on it by the IMF and negotiated in secret without any input from democratically elected parliaments. And that will be relevant, I think, to talking about that proposition, which also, by the way, has some interest from Barney Frank, will have some relevance to what went on in Congress and hopefully is still going on in Congress. For folks who have been working around IMF issues in Washington for some time and trying to figure out how to, well, there's a step back, maybe there's this obvious imbalance, which is, but for a little surge of interest around 2000 and 2001 when we had lots of people in the street, there's not a lot of awareness about the IMF and the World Bank in the United States. There is massive awareness about the IMF and the World Bank in the developing world, especially in the poor countries where they determine policy. And of course, the imbalance that we're all familiar with is that those countries which suffer the effects of the policies that are imposed upon them, that are aware of the key roles of the dominant institutions, have little or zero influence over the policy making at those places. And here in the country where people don't know what's going on about the IMF, because it doesn't have anything to do whatsoever with what goes on in the United States, we have enormous potential influence. So the handful of us who try over time to bridge that gap think about how can we lever congressional authority primarily through the appropriations process, which comes along about every decade for the IMF, or directly or indirectly by giving instructions to the U.S. Executive Director, the representative of the IMF, about how he or she should vote and conduct business at the IMF. So we recognize that there was an opportunity end of 2007, beginning of 2008, when the IMF, at a very different moment in the global economy and in the IMF's history, was in deep distress, starting to lay off staff, and looking for a new business model to keep paying for its administrative costs. And it came up with this idea of selling some of the gold it holds to create a trust to pay for administrative costs. And that was interesting in a variety of ways because people had campaigned to sell that gold to help poor countries with minimal success over time. But in any case, as a fact of as an accident of history, that requires congressional approval. So a number of us, acutely aware of IMF policy impacts, especially at that point in time in Africa, saw this as an opportunity to try to leverage some changes in the way the IMF did business. We were motivated by things like a study that came out in the middle of 2008, which seems, 10 years ago, as news has become so crunched and the economy becomes such a dominant story. It's hard to remember life before the crisis, but there was life before the crisis when there was still a crisis. And this story that came out in the journal PLOS looked at the effect of IMF policy on Eastern Europe, former Soviet Union, and TB rates. And what it found was there was a direct correlation, and strong inferences about causation between IMF lending and TB incidence and mortality rates, with basically you're saying 15% increase in TB rates and deaths in countries that had IMF loans after the collapse of the Soviet Union. And it was a statistically robust study, and that translated into tens of thousands of people who died who wouldn't have died. So this is non-trivial impact. And we were interested in trying to come up with ways to address this fact. Now, the position from the IMF was, A, that the study was really bad, which I think is wrong, and B, we, the IMF, don't instruct countries to cut their healthcare spending, which is an interesting defense, and to some extent, not totally, but to some extent true. But it ignores the overall macroeconomic policy prescriptions from the IMF and how those inevitably cause reductions in healthcare spending and increases in bad health outcomes. So we tried to fashion policy to deal with this. But we had there's this idea that, and moreover, we don't cut healthcare spending, but we used to. But we don't do that anymore because now we've changed. And this is this interesting theme that, admittedly, the World Bank owns a little bit more than the IMF, but the IMF is trying to catch up right now, is that we've changed. And I'm going to jump ahead on this part of the story before going back to what's happened in Congress. So obviously the crisis, was deepened in summer of 2008, and then the economy fell off the cliff. In September 2008, massive impacts immediately for Eastern Europe and much of the developing world. And it was clear there was going to be a need for huge infusions of funds into developing countries. IMF was suddenly in a very different situation, started making large-scale loans to low-income countries, which it had not been able to do over the previous decade or so. And we started hearing again this stuff about, well, the IMF had changed, and people would say, well, the new executive director, the new managing director, Strauss-Kahn, saying interesting things about stimulus, but then we would look at what was happening in countries that were receiving IMF loans, and they were not being permitted to undertake stimulus policies. They, in fact, were being instructed to take contractionary policies. And people would do a review of this, and then the line from the IMF, which I have to say came in directly, primarily as we were working on the Hill, was, well, you're looking at things that are old, and now we've changed. So if you're looking at something in October, and you're giving a loan in October, and you're complaining about it in November, that's old, we've changed. You got to look at our more recent stuff. And it's sort of this impossible standard. So then people do an analysis of all the crisis loans from September through the end of January. It starts circulating on the Hill, and it raises some eyebrows because it's actually totally devastating. Every single one of the crisis loans includes reductions in budget deficits and hikes in interest rates, so contractionary spending and recessionary times. And the story is, well, that's all old. It's January now. You're looking at what happened in September, November, December. That's too old. And then, okay, there's updated versions of that study. And again, it's too old. And we're just on the Hill a few weeks ago, and stuff from April is too old because we've changed. Now, I really hope that the IMF has changed. I do, and I want to talk about that in a second. And it has changed in some ways that are not totally trivial. In some ways that maybe are. But it's a very difficult conversation for a lot of us to have. 2 minutes, and I haven't got to the gist. It's a difficult conversation to have, but it's part of the framing of this, I think, anyway. Because there's this issue of actually catching up of aligning the rhetoric with the actual record. And I know Mark is going to cover a lot about the details of the record of this stuff. Let me quickly talk about what happened on the Hill. A lot of us said, okay, now there's going to be a big infusion of money for the IMF. It shouldn't go, since the logic of it was we got to help promote global stimulus. There should not be money for global stimulus if the conditions the IMF was attaching with that money were recessionary, right? Was not advancing global stimulus if they're imposing recessionary conditions. And so we said there ought to be a number of conditions on what goes on with the money, the short version of which is the IMF should not impose recessionary conditions on countries that are in recession unless it can show that those policies were necessary and can't be delayed. And that was the core demand. There were other demands about exempting healthcare and education spending, and also, not unimportantly, that parliaments be required to approve IMF packages before they become law. To deal with the issue that I was talking about at the top. Now, it was a complicated congressional process that got mired in both the pledge of the president to give money to the IMF, which I don't think was well thought out in the first place, plus the need to get the supplemental through to fund the war, which was a very important issue to the administration, plus the fact that the administration just didn't want to lose a floor vote. And they rammed this thing through a process that really did not allow any serious debate over the IMF issue, unfortunately. But the question that remains is, what is wrong with a set of conditions that we and others were urging? If the IMF has changed in the ways that it says it has changed, why doesn't the IMF itself, without any external pressure, just adopt that set of policies? Why isn't the presumption that you don't impose contractionary policies on countries that are in recessionary times? And why would there be an unwillingness to show that it's necessary to do so in the cases, which shouldn't be the majority, where it's viewed to be necessary? Why won't the IMF, or why doesn't the IMF say, as Nancy and others have urged, that it will do an assessment in advance of loan packages about how it expects those loans to impact on poverty, so they can measure over time whether the results are comparable to what was projected? And finally, even though I've got this little note to wrap up, and I'm not going to give this issue justice, thank you for taking it away. The next note is finish, done, sit down. Mike, they have the problem is I'm on Mike. The last thing is, why isn't there more open-eyed and fresh-looking at the issue of capital controls? If the overriding concern for the IMF is that countries can't maintain expansionary policies because there'll be capital attacks, or capital flight, attacks on the currency, why isn't there more creative examination of capital controls, especially in light of the history of the last global economic crisis, where the IMF's own analysis showed that countries that imposed capital controls did better than those that didn't, and in the context of this crisis, where countries like India that have some minimal controls are actually doing better preserving their economies than countries that don't. And with that, I will wrap up. Thank you, Nancy.
Thank you so much. Our next speaker is Mark Weisbrot. He's co-director of the Center for Economic and Policy Research here in Washington. He received his PhD in economics from the University of Michigan. He's co-author with Dean Baker of Social Security, The Phony Crisis, and has written numerous research papers on economic policies, as any of you who have looked at the table outside can see. It's covered with CEPR publications. He writes a column on economic and policy issues that's distributed to over 550 newspapers by McClatchy Tribune Information Services. His opinion pieces have appeared in the Washington Post, the Los Angeles Times, the Boston Globe, and most major U.S. newspapers. He appears regularly on national and local television and radio programs, and he's also president of Just Foreign Policy. Mark. I don't know how many people are in the hallway, but there is a little bit of standing room.
Thanks, Nancy, and thanks to Liana and the other panelists. And I want to especially thank the Boell Foundation for getting a panel together that has the IMF sending a representative, because we've tried that for about 10 years and have not succeeded. In fact, it almost never happens, and it certainly, you'll probably never see two critics of the IMF on one panel here in Washington. A few panels that I've been on where there's been actual debate, it's almost it's a minimum of 3 against 1. So I'm very pleased to be here, and I want to start by addressing some of the economic issues. Rob did a great job, I think, outlining the context. And You know, and just if I can add one thing about the context, you know, on NPR this morning, they reported on the war supplemental bill having passed. And they mentioned, now for those who didn't see the last 2 weeks, I mean, the White House and the leadership of Congress had to twist arms, break heads, and it took them, you know, 2 weeks to get the votes to pass this because they had the IMF money attached. It passed the House easily, you know, when it didn't have that. And the NPR reported this story, and they mentioned the cash for clunkers and every little item that was attached to the bill. Didn't mention the IMF money. So that's how much the media completely missed the story here. And of course, one of the reasons why the IMF money can't pass the House, it failed on 3 votes back in 1998, is because it's not necessarily going to do good in the world, and there's a lot of people who realize that. I mean, the most obvious thing that the money is going to be used for, and I'm not the only one who said this, Simon Johnson just wrote a column about it a week or 2 ago. He's former chief economist of the IMF. He said that the money is going to go to bail out banks. Okay, banks in Western Europe have loaned about 1.4 trillion at least in Central and Eastern Europe. They're going to be facing very high default rates, and I think a lot of that money is going to end up bailing out those banks. There's enormous amounts. I mean, Austria has loaned 64% of its GDP, Sweden over 20%, Belgium over 20%. So these are enormous sums, and the Eastern European economies are doing very badly, and there's Latvia, Estonia, Lithuania are on the brink of default, which would mean, massive defaults from the private sector because they borrowed in euros. And so, you know, this is very important to understand, and not just the politics, but the economics, okay? As a number of economists have already pointed out, you know, what the IMF is imposing together with the European Union, I want to give everybody full credit. And by the way, the U.S. Treasury is the principal overseer of the IMF, so you can, I don't want to blame the IMF here for everything. It really is the United States Treasury Department that has a veto power over what the IMF does. So, so what are they doing in Latvia? So a number of economists already compared it to what they did in Argentina between 1998 and 2001, which is basically to maintain an overvalued exchange rate and try to adjust the external imbalance, the current account, by shrinking the economy. And you can do that, right? We just look at our trade, our current account deficit is down from 6 or 7 at peak to 3.3% now. We're doing it right here in the United States, but not deliberately, okay? We're doing it because we have a terrible recession. We've lost 6 million jobs. Okay, well, you can do that as a matter of policy. If you want to keep your currency fixed and in a situation where it's very overvalued, you can shrink the economy. And that's kind of what they're doing there. And when, you know, it's not, and that's what they did in Argentina. And ultimately, historically, this has almost never worked. In Argentina, ultimately, the currency collapsed, but they had to go through the worst recession of their history from 1998 to 2000, end of 2001. And so this is what's happening in Latvia. And, you know, when you mention the history compared to Argentina, you could also have compared it to Russia, Brazil, any number of countries where the fund has made this mistake and it's had disastrous consequences. So there's this whole history, and when people in Congress tell us, you know, the IMF has reformed and the IMF says it's reformed, we said, well, why are you doing the same things? Rob mentioned the pro-cyclical, what economists call pro-cyclical policies. That means it reinforces the business cycle. So if you're in a downturn, it's reinforcing the downturn. So primarily cutting spending, money supply targets that are pro-cyclical, that is shrinking the real money supply, raising interest rates. In El Salvador, Pakistan, Ukraine, Turkey, Latvia, Hungary, Belarus, Serbia, Armenia, those are some of the agreements that you've had just since September last year that have pro-cyclical policies. In fact, the majority of the IMF agreements outstanding, there's something like 50 of them now, have pro-cyclical policies, in spite of the fact that the world economy is in recession, and most of these countries are either in recession or their economies are decelerating at a rapid pace. So, you know, I understand the IMF has an argument. you know, and maybe Hugh will present it. I mean, the economic argument is that there's no choice, that these countries have external imbalances, or they have sometimes internal imbalance, a budget, large budget deficit, big national debt. But in many cases, it's just not true. I mean, they're shrinking the economy or they're restricting spending and cutting the budget deficit in Pakistan and Ukraine. In all of these countries, some of them have very low debt to GDP ratio, for example. And, you know, so it is possible that in some cases, even in a recession, a country has no choice but to cut spending or pursue pro-cyclical policies. But it's inconceivable from an economic point of view that this could be true in most of the 50 countries where there's agreements in a time of world recession. It's, you know, in a time when inflation is falling, these are some in a lot of these countries, and you're shrinking the money supply. I mean, this does just not make sense. You know, if I can quote Marx here, not Karl, but Groucho. If I can paraphrase him, I would say the IMF has mastered the art of looking for trouble, finding it, misdiagnosing it, and then misapplying the wrong remedies. And this has been the history now.
Which movie was that? I'm sorry, which Marx Brothers movie was
You know, I
that?
can't remember.
Monkey business.
Oh, thank you. Thanks, guys. So, we always want to give the right source. What? Okay, so where is the reform? I'm willing to acknowledge reform when I see it, because we've been fighting for it for 11 years now. And there is now the flexible credit line the IMF has, right? Where you don't have conditions. But that's kind of limited. I mean, so far the only countries that have qualified are Mexico, Colombia, and Poland. So it seems like you have to be a right-wing government and also have a certain relationship with the United States, whether it's military or political. And so that to me does not seem like a huge advance for the world, although it's very good for those particular countries, especially Mexico, between the flexible credit line and the money that the Fed has put up in terms of the swap arrangement. They can be pretty certain that their currency, they can stabilize their currency. So if the IMF were to extend that to other countries, now that would be a real, I think, significant reform. But I don't see that happening in the near future. And this is the problem, again, that Rob pointed out, the problem of the political control. This is an organization, it's 185 member countries, and the United States proudly boasts in the congressional debate that we're giving this money so we can maintain our veto power. And if you look at the pie chart, I have them here, I didn't bring a PowerPoint, but you can put up the pie chart to show the changes that were made in 2006 to the voting share, and you can switch back and forth between the original and the new one, and you can't see the difference. Okay, that's how small. It's a glacial pace of change here. Now, the other thing is, and very often there are other choices for countries, that they can take, and the IMF, comes in a crisis and tries to restrict those. And that's what they did in Argentina for 4 years. And when Argentina finally got out from the IMF and did what it had to do, devalue the currency involuntarily, it collapsed, and defaulted on their debt, they did quite well. They've had 6 years of the fastest growth practically in the hemisphere. They had 60% growth. And they did very well, and they had to face down the IMF. They had to literally default to the IMF in December of 2003 temporarily to be able to pursue the policies that led to that successful recovery. So when we, Rob and I talk about the pro-cyclical policies that the IMF imposed, that's only half the story. The other half of the story is the positive policies that the countries could take if the IMF were not involved in their decision making. So this is a huge thing that's going to go on for years to come, and I'm afraid it's going to take a lot of public education. And this congressional vote, obviously, we were sad to see this. There were 32 Democrats who held firm under all the pressure and the threats from the White House and the leadership, and I'm very proud of them for having done that. But what that vote really means is that if the White House and the leadership really want something, they're willing to do whatever it takes to get it, they can get it. And that's normal in a democracy when both the presidency and both houses of Congress are controlled by by a party that has a majority. So, but I don't think it means that there's public support. And if I could mention just one thing that I think is left out of the debate but needs to be introduced, and that is the impact on the United States. That crisis in Asia, which is in the Groucho Marx definition applies there, and most economists agree what happened, what the IMF did in Asia 11 years ago, that had an impact on the United States. Those countries were basically forced to export their way out of that crisis on the basis of undervalued currencies. That continued for the whole decade, really, not just getting out of the crisis, but also piling up enormous reserves so that they would never have to go back to the fund again. And the impact of that on the United States, well, I would say it contributed enormously to the huge trade deficits and the loss of the 4 million manufacturing jobs that we've lost during that time. So it does impact the United States as well. This huge imbalance in the world economy that is now adjusting was piled up partly because of how the IMF dealt with the last major financial crisis. Thank you.
Thank you, Mark. Our next speaker is Hugh Bredenkamp, Deputy Director of the IMF Strategy Policy and Review Department and head of the newly created Low-Income Country Strategy Unit. Since joining the IMF in 1988 from the UK Treasury, he's worked on countries in Western Europe, the former Soviet Union, Asia, Africa, where he was mission chief for Ghana. On the policy side, he was closely involved in the development of the Highly Indebted Poor Country, or HIPC initiative, and the creation of the Poverty Reduction and Growth Facility at the IMF, which provides arrangements for low-income countries. From 2004 to 2007, he served as the IMF's resident representative in Turkey. And almost since he came to the fund, I've known Hugh, and he's provided a very helpful bridge between the IMF and the external communities. So I welcome you here.
Thanks very much, Nancy, and thanks to Heinrich Boell and CEPR for the opportunity. I don't mind being outnumbered on the panel. I'll try to do my best to respond to the views that have been expressed and also give my take, which, as you may imagine, is a bit different on some of the issues that both Rob and Mark have raised. And let me try to pick the issues where I'd like to sort of convey the sense that the fund's take on policies, both in general and in specific countries, is very different from the way it's typically portrayed and the way Mark and Rob have portrayed it in their opening remarks. Let me start first on the question of the global fiscal stimulus, which I think is a good illustration of how the fund's position often is very much at odds with the stereotype of our policy view. Back in as early as January 2008, Managing Director of the fund, Dominique Strauss-Kahn, at Davos, was urging global fiscal stimulus to address the crisis. This was 9-10 months before the financial crisis broke in September. There was a lot of surprise among long-time fund watchers, a lot of skepticism from major policymakers around the world at that time about whether that was the right policy response. It took a few months for policymakers to respond, and in the end they did, primarily driven by the financial crisis in September, October. And the reality is that the result has been that, in fact, we do now have a global fiscal stimulus underway of 2% of world GDP. It was not as seamlessly coordinated as we would have liked. The MD pushed for coordinated global effort to maximize the impact. But we did, in the end, get more coordination on this, perhaps, than we've ever seen in previous crises. One question then immediately arose was, is the fund really being even-handed in this? I mean, aren't we quick to condone or even advise advanced countries to do fiscal stimulus while pushing austerity on developing countries? And I think, the reality is actually quite different from that. Yes, we have advocated different policies for different countries in different financial circumstances. So there is no one-size-fits-all prescription. But that differentiation is not advanced countries versus developing countries. It's not program countries versus non-program countries. It cuts right across the spectrum. There are a number of advanced economies where we have advised against fiscal stimulus, or at least caution, because of the country's high debt situation in Italy and Greece, Spain, for example, where the view was that fiscal expansion in the current circumstances in these countries would actually be counterproductive. Conversely, there are many low-income countries that have manageable deficits, manageable debt situations, where we've actively supported widening deficits in 2009 to preserve or even increase government spending. I'll come back a bit on that in a minute. Similarly, for the emerging markets, we've welcomed stimulus measures in the stronger economies like China and Chile, Indonesia, Thailand. But we've also, in countries where there were severe vulnerabilities even before the crisis, going into the crisis, we've urged caution. And in some cases, we've advised fiscal consolidation. And that does include some, but by no means all, of the emerging market countries that we've supported under lending programs. And that brings me to the specific question and the assertion that both Rob and Mark made, that in all the fund programs in these countries we have pushed for tighter deficits and fiscal austerity. That's simply not the reality.
I didn't say all. I said the vast majority.
The vast majority, okay. It's not actually the vast majority. If you look at the 18 recent standby programs, which is basically all the programs, including the ones that Mark mentioned, there is an increase in deficit in the fiscal deficit programmed in 2009 in all but 4 of those cases. So 14 out of 18 is not a minority. In some of those countries, in most of those countries where the deficits are rising, it is the automatic stabilizer effects that are driving that, which is good actually from a policy point of view. Automatic stabilizers are a good way to counter recession because they adjust, as the growth outcomes or the depth of the recession in the case of a recession are those effects are very uncertain. So to rely on automatic stabilizers is a good way for policy to adapt automatically as the economic situation evolves. But there are also a number of countries, Guatemala, Colombia, Costa Rica, Iceland even, where the programs include additional fiscal stimulus on top of the automatic stabilizers. That is an actual discretionary stimulus. Now, you might ask, well, why are there any programs where we are advocating fiscal tightening during a recession? It's a perfectly reasonable question. There are a number of reasons why this might be necessary or even advisable in some cases. One example is Hungary. Hungary has a external debt ratio now of 140% of GDP. It has a public debt ratio of 70% of GDP. And this is an example of a case where trying to carry out fiscal expansion from that starting point would actually destabilize confidence, and that would exacerbate the downturn rather than preventing it, which is what we want. That view is not a view that we imposed on the fund. The Hungarian government has been at least as vigorous on that point as we have. In Ukraine, which is another case where the policies, at least in the initial program, involved fiscal tightening. The problem initially was the simple lack of sufficient financing to do fiscal expansion. Those financing constraints have since eased, and in all of these programs, the fund is we're not only putting in our own money, but we're trying to raise as much financing as we can for these programs, but the money is limited, and in the end, policies have to be tailored to the financing that was available. As the financing constraints were eased, the program was modified, and the deficit target for Ukraine now in the program is 4% of GDP, up from 0, so that's a very significant adjustment. Latvia is another case that was mentioned, and here fiscal policy is very tight, but it's a direct consequence of a strategic decision that the Latvian government has made. It's not imposed by the fund by any means. Their strategic decision is to pursue euro adoption. That's a key, has been and remains a key goal for them. So they insist they want to maintain the pegged exchange rate. They're willing to do essentially anything, whatever's necessary to maintain the peg. And they want to put the fiscal position on a sustainable path, on a path to achieve the Maastricht goals so that they can join the euro. That's a choice they made, and it has certain implications for fiscal policy which are in a sense inevitable. So the bottom line is, Rob said, and I scribbled this down because it struck me, the fund should not impose contractionary policies unless it can show they're essential and can't be delayed. Why don't we adopt this policy? Well, that is our policy. In fact, we would like to see as many countries as possible pursuing expansionary policies where we think those will help get the country out of the recession. But there are cases where policy tightening is not only unavoidable, but in some cases actually could have a positive effect, as it did in Turkey, by the way, which is a case I know quite well. Let me say a quick word on low-income countries, which is more my domain, I have to say, than the emerging markets. There, the picture is even clearer. If you look at all up, and I just focus now on the program countries, program cases in the low-income country domain. In 80% of those countries in Africa, 70% worldwide, we have budget expenditures rising in 2009. Not falling, rising as a share of GDP, and GDP in these countries, unlike some parts of the world, is still rising. So expenditures in real terms are rising even faster, despite the drop in revenues. So we are accommodating rising deficits on average of about 3% of GDP, widening of the deficit in 2009, and higher expenditures of about 1.5% of GDP in program countries. So we do try to build in fiscal space wherever we can. On low-income countries, a lot of this is going to depend on the donor response, and the fund has been very forceful in advocating in the donor community for higher aid. The MD has been out in public saying that the donors need to fulfill the Gleneagles commitments to scale up aid so that the countries can support spending without getting back into debt difficulties. A number of other points I could make, which probably I will save for the discussion since Nancy wants me to wrap up. So thank you very much.
Thank you so much, Hugh. Our next speaker, our last speaker, is Doug Rediker. He's currently director of the Global Strategic Finance Initiative at the New America Foundation, which focuses on the relationship between global finance, capital flows, and foreign policy, with an emphasis on the role of the U.S. In 2007, he returned to the U.S. after over 16 years in Europe, where he served as a senior investment banker and private equity investor for what were at the time some of the leading financial institutions in the world, including Salomon Brothers, Merrill Lynch, and Lehman Brothers. As head of Eastern Europe, Middle East, and Africa investment banking through much of the 90s, Doug was responsible for establishing operations in several countries and for originating and executing major transactions in Central and Eastern Europe, Russia, Turkey, and Central Asia, including many landmark privatizations. Doug has testified before U.S. congressional committees and moderated and participated in panels at the World Economic Forum that were focused on capital markets and emerging market investments. He was a member of the steering committee of the Clinton Global Initiative Task Force on Political Risk Insurance for the Middle East emerging markets, and is a member of the International Institute for Strategic Studies and the Royal Institute of International Affairs. He's published opinion pieces in a broad array of media, and we welcome him here today.
Thank you. Good morning. First, I've got to shorten my bio, obviously. But second of all, the interesting thing is, in the one phrase that you left out of that was, or that was not provided to you, was that what I focus on is the role of the U.S. in a multipolar financial world. And I raise that because I've written some remarks, so I'm going to read what I wrote last night, if I may, and then we'll get into the discussion. But I take a somewhat different perspective. Certainly than I think all of the other panelists, but I would suspect than almost everybody else in this room. So if you'll indulge me and let me make this point, I think my starting point after 16 and a half years in Europe, and I've been back in this country 2.5 years, is we cannot be so terribly myopic in the U.S. as to believe that what goes on in this town and in this country, whether it relates to the IMF or otherwise, is simply ours to determine, because the world has changed. So I only mention that because the phrase multipolar financial world, when I wrote it 2 years ago, was an obvious statement to make, because the world is much more multipolar, and certainly in the financial circles it is. So the fact that it was left out, I didn't realize actually it was a controversial word when you define it, the U.S. as part of a multipolar world in any way. People don't like to hear that. I consider that to be a given in the premise. So just
I did that intentionally
There
to
you go.
provide an opening.
There you go. Okay. I'm pleased to be here today to talk about the IMF and its role in addressing the global financial crisis and the global financial system. It's an evolving role. It's already undergone some very real and significant shifts. Some of these shifts reflect the organic evolution of the institution over time. Some are the result of learning from mistakes. Others occur as a result of broader shifts in the global, political, and financial landscape and the financial balance of power. And perhaps most important, the IMF has seen its role evolve this past year as the direct result of reacting to this past year's dramatic global financial events. Events that required significant and rapid action on the part of many financial and political actors around the world. I am not here today to defend the IMF from those who have issues with its actions over the past decades, nor am I here to discuss specific actions in specific countries and things that, with the benefit of hindsight, could have been done differently. I'm also not here to defend the Washington Consensus, as succinctly put by Gordon Brown at the recent G20, quote, "The old Washington Consensus is over." I am here as an observer who spent most of the past 20 years living outside the U.S. with extensive international financial experience, specifically in the emerging markets. I'm also here as one who often needs to be reminded that the perfect should not be the enemy of the good. This crisis has, I think, served as a needed reminder of the good that the IMF can in fact do. I referred earlier to the macro shifts in the global balance of power. But while the U.S. continues to play a central role at the IMF, it would be wrong to assume that the IMF is somehow insulated from the shifting dynamics and increasing multipolarity, there's that word, of the world's financial markets, financial players, and political actors that we have seen over the past decade. The 21st century is already characterized by the creation of vast pools of capital outside of the U.S. and by the ascendancy of large and liquid financial markets that exist far beyond Wall Street. The U.S. is not the keeper of the only set of keys to the world's financial markets. Sources, destinations, and markets through which the world's capital flows are simply not under U.S. monopolistic control. While the IMF is not a direct reflection of this dynamic, it is nevertheless impacted by it. Today, the U.S. is not the sole or even the primary source of new IMF funding. Moreover, the IMF is not the only means by which countries can exert international financial influence. Beyond country-to-country bilateral approaches, there are regional alliances, regional development banks, and new organizations which are increasingly seeking credibility and in search of ever more meaningful roles. Earlier this week, we even saw the first conference of powers brought together by a clever acronym created by an investment banking analyst, the BRIC conference in Russia earlier this week. These alliances do not mean that the IMF is of less stature or that the U.S. is in fear of losing a significant, if not dominant, role. But in the case of how the IMF operates and the U.S. role, it would be wrong to assume that we can act as if there is no alternative. There is no alternative is not a strategy. Rather, as the IMF continues to evolve, we have to acknowledge that there is, or well could be, an alternative. When other governments sit on well over $6 trillion of reserves, there is no reason to believe that they will not consider using these reserves to further both their domestic and international interests. That may not provide a better alternative for anyone, and I don't believe that's a risk worth taking. The IMF plays an important strategic role in ensuring the countries are not forced, as their last resort, to accept deals from financial partners on far more onerous terms than those offered by the IMF. Remember Iceland? Last fall, Iceland, a NATO member, found itself facing imminent financial collapse. When its pleas for immediate help went unanswered by its traditional allies, it went public with a last-ditch approach to Russia for a €4 billion loan. Now, the Russia deal was never consummated, in part because the IMF stepped in. This is a quote. "We have not received the kind of support that we were requesting from our friends, so in a situation like that, one has to look for new friends." Now, unlike the IMF and other developed nations, the financial crisis that originated in the US and in Europe has dramatically limited developing countries' ability to access traditional sources of funding needed to keep themselves afloat. It is precisely in these cases that the IMF is of crucial importance as a provider of financial stability and as the lender of last resort. It is a role that they have, I believe, already played with great skill and speed in Pakistan, Hungary, Ukraine, and elsewhere. The IMF plays a very necessary role in providing a safety net for these countries, so they don't need to look for new friends. It provides broad global benefits by lessening the risk of creating failed states and in providing surplus countries with an alternative to hoarding vast amounts of precautionary reserves. While the IMF has not always been successful in its previous endeavors, during this crisis, I think it's shown itself to be creative, flexible, and forward-looking. In particular, the creation of the flexible credit line mentioned earlier was announced just in time to provide a boost to countries like Poland, Colombia, and Mexico before they actually needed it. Now, even if we believe that the worst of the global financial crisis is behind us and that green shoots are somehow sprouting everywhere, there are clearly many fundamental imbalances and structural issues that need to be addressed. Even many optimists agree that the full force of this global economic crisis has not yet been felt. At times like these, the IMF is a key player in making sure that no country is forced to look for new friends. Thank you.
Thank you very much.